Great, thanks everyone for the applause. Michael needs no introduction. We at Barclays have been extremely fortunate to be able to work with Michael and his world-class team over the past 2 years. It's been an iPhone moment, I would say, creating securities that investors didn't know that they needed, quite frankly. And so, without any further ado, we've got about 20 minutes. I'd like to start off, Michael, with the evolution of the capital markets activity we've been doing, the products leading up to what we have today, which is Stretch.
At the 2026 Bitcoin conference in Las Vegas, Michael Saylor steps in. And what he says doesn't feel like a prediction anymore. It feels like something already in motion. But before that moment lands, stop for a second. Because what you think you know about money might already be outdated. A system where your bank quietly loses you money every year, and you don't even notice it. Now Saylor is talking about something different. Not Bitcoin as a trade, not even as an investment, but as a structure quietly being built into the financial system itself. And the uncomfortable part is this. While most people are still debating price charts, something else is happening underneath. Capital is already moving. Systems are already adjusting. And very few are paying attention. Because imagine this, a financial world where money doesn't just sit. It produces yield, automatically, at scale, globally. That's what he's hinting at. But here's where it gets strange. This isn't happening in the future. It's being built right now. And if he's even partially right, then the real question isn't what Bitcoin will do next. It's who already positioned before you even understood the shift. Listen closely, because this is where it starts to get real.
Yeah, I think Stretch is an amalgam of all of the good things that we discovered on our way to the revolution and our attempt to run away from all the bad things. So what worked really well? 4-letter tickers that are available from broker-dealers on NASDAQ worked well. At the market shelf registrations, we thought that was a magic tool. Amplification via something other than just straight equity, we thought that was good. What we didn't like is over-the-counter 144A issues because the entire retail market and public investors were locked out, so that was bad. We didn't like debt that came due with a certain date because it created a huge amount of credit risk and uncertainties. So that's bad. We didn't like the fact that we were trapped in a small set of niche corporate bond markets without a lot of flow of capital. That was bad. And so eventually we discovered preferred stock so we could sell a security to the general public everywhere in the world that was perpetual, so you could attach a shelf registration to it that anybody could buy. And so STRC represented a walk, down that stack to preferred, and then in the preferred world, it represented the shortest duration, least delta, most stable, least volatile security. And so I would say it represents the highest amount of financial engineering we've done, but the result of that was the simplest product we'd ever created. It's just like when the iPhone didn't have a keyboard. It's like fewer moving parts. So by the time the dust settles, Stretch just becomes a Bitcoin-backed high-yield bank account that pays you double digits. And the last part, just serendipitous, was that we found that if you sell a credit instrument and then you make a capital investment forever, and then you hold the capital forever, then the dividends that we pay on the credit instrument become a return of capital. So we created the most tax-efficient perpetual instrument because of the total simplicity of the idea, which is make a capital investment forever, strip the volatility and the risk off of it, and convert the capital gain into a defined dividend stream. that's tax deferred. And I guess we had to do everything else to get there.
Right, and can we dig a little more into amplification and how you're using your common ATM paired with the pref ATM on Stretch to manage amplification and leverage on your balance sheet?
You know, the goal is just to acquire as much Bitcoin as possible. Or just try to make as much money as possible. It's not a complicated goal. Bitcoin is money. We want to acquire the Bitcoin. We expect Bitcoin to go up forever. It turns out that if you want to pay a tax-deferred dividend, then you need to monetize an unrealized capital gain. And so if we sell $1 million of Stretch and we buy $1 million of Bitcoin and Bitcoin appreciates 30% a year, then we've got a big capital gain in the Bitcoin. You want to monetize that in a tax-efficient way. There are two ways to do it that are pretty obvious. One way would be to sell the Bitcoin as long as the tax basis is higher than the sale price. So if you can sell high basis Bitcoin, then you can actually generate a cash stream to pay the dividend just with the Bitcoin itself. The easier way is you sell a derivative of the Bitcoin, a derivative of the capital asset. And it happens that we have a derivative, and the derivative is MSTR, the common equity. So when we're selling the common equity, we're selling a derivative to generate tax-deferred income that we can pay back to the credit investors. And when we're selling the equity at a premium to the underlying NAV, then it turns out to be accretive to the common stock and a benefit to the credit investor. So what we generally do is we use the equity ATM in order to generate the cash stream to pay the credit investors. Most of the amplification for the equity comes from the credit. If you sell $1 million of credit, then you've got $1 million of Bitcoin and you didn't actually dilute the shares at all. Over the course of the next year, you'll issue 10 or 11%, but what you're doing really is you're generating massive upfront amplification. Another way to amplify is you just sell equity at a premium to NAV. If you sell $1 million of equity at MNAV of 2, then you've created $500,000 of BTC gains. That's also amplification. We've done that. In the future, we may do more of that. We do it occasionally. We did it last week. We sold $255 million worth of equity at a premium. We generated a Bitcoin gain and some amplification on that. And we expanded our capital base to support the credit issuance. But for the most part, if we sell $10 billion of STRC, we'll generate a $10 billion gain on that up front. So most of the BTC gain and the yield comes from the credit, not from the equity right now.
Okay. In addition to the success of the instrument itself, it's now effectively proven. We've seen resiliency through a lot of volatility, the Iran conflict, et cetera. The product is performing. Now we move into the integration phase of Stretch. Can you explain to us some of your goals in terms of working with banks, asset managers, other providers in integrating Stretch into their corporate priorities?
Yeah, well, what we realized is the 3-layer stack is going to be digital capital, like a 30 to 40 ARR, 30 to 40 vol commodity. Digital credit, about a 2 vol, 10, 11% yielding instrument. And then the 3rd layer is digital money or digital yield. And digital money would be a 0 vol, a pure money market type instrument that pays something better than normal money market. So maybe 0 vol, 8%, or in that range. So one compelling thing you can do with credit is create digital money. And you can create digital money in the form of an ETF or an ETP, or you can create it as a token, or you can create it as an account. So I think important integrations are integrating Stretch into public ETFs in order to create that sort of instrument. I think integrating it into crypto exchanges. At some point, some crypto exchange will just offer you a digital yield account or digital money account that pays 8%. You just put your money on the exchange, they pay you 8% for your money on deposit. And then I think the third is the emerging class of savings coins. There's a $350 billion stable coin market. A lot of them want to generate yield on the stable coin. So the way that works is you buy the stable coin, you stake the stable coin, you get back a savings coin or a yield-bearing coin. And STRC powers the yield on savings coins. In fact, I would say everybody's looking for how do I generate yield on Bitcoin or how do I generate yield on stable coins. And so Stretch, or digital credit, is like an ideal way to generate that yield on either of those. And you can do it on chain, you can do it via DeFi protocol, and people are working on it with DeFi protocols in the Bitcoin world and the stablecoin world. Or you can do it probably just on a centralized exchange, or you could do it with a bank. Right now, I see about a dozen projects that are going on in this area. Maybe 12 to 24, it's exploding. And all of those are different approaches. There's an explosion of entrepreneurial activity right now.
That's great. So thank you for that. What we're also seeing is we feel the adoption. The adoption's happening. The regulatory framework has improved so much. We all are here because we're believers. We all want to get to yes. But what are the constraints of the adoption that still exists today for digital credit as a concept through TradeFi, et cetera? And how do we, as a group, try to influence change and fuel adoption?
Well, digital credit is based on digital capital, and all of that law is settled, and there's global consensus on Bitcoin as digital capital. The digital credit instrument like STRC is based upon publicly listed SEC-compliant preferred stocks. All of that law is settled. The securities law is 100 years old. The tax law is 100 years old. So all of that law is settled as well. And so I don't think there's any question digital credit's going to work. There's $3.5 trillion in private credit right now, and that $3.5 trillion is getting 8.5%, 9% yields. It's totally illiquid, and if even 1 or 2% of it flows into digital credit, this will be an explosion. I don't know why you wouldn't have 10% of it, $370 billion, just coming out of private credit flowing into digital credit. It's all illiquid, opaque, under-collateralized, unrated stuff. So digital credit, if it got even 1 or 2% of the junk bond market, the private credit market, you know, or other sorts of exotic credit, it would be exploding. In fact, if you look right now at STRC is the largest preferred equity in the world, and it is the most liquid preferred equity in the world, and the fastest growing, maybe one of the fastest growing, you know, financial products in the world, all in the first 8 months. And that's without any of this happening. So I think that the digital credit train has left the station. Stretch is working. Even today, SATA, you know, is like, what, $99.99, hitting par right now. So you can see that asset class is working. Both those instruments are working right now. I think that all of the uncertainty is really just opportunity. If you can generate 2 vol 10% yields, then you have the universal most desirable active ingredient in every financial instrument in the world. There's $300 trillion of credit, $100 trillion of equity. So you have something better than $400 trillion worth of stuff if you don't like 10%, you can just loop it 2 or 3 times and get 25% with 2 or 3 vol. It would be 10x better than the S&P index. So I think the interesting question is, which ETF funds, I know Bitwise is working on a fund, Strive is working on a fund, which ETF funds will come out with the most compelling digital yield or digital money instruments? Which token issuers are going to win the DeFi world? I think Apex has gone from whatever, not much to $200 million in a matter of weeks. So you've got hyper growth, companies that are going 0 to 100 million in days. So when you see one of those DeFi stablecoin protocols go through $1 billion, that'll be a big deal. And then I think, which bank, like which will be the first bank to offer you a digital money account or digital yield account that pays 8% on your dollars? I mean, there's not one bank in the world, but it only takes one bank to decide, why don't we just give people 8%? And every bank in the world is literally one regulatory approval away. They just got to go to their banking regulator and get the sign-off to offer a digital yield account. And you're the bank that offers 8% instead of 3%. I don't know why you wouldn't slurp up 10, 20, $50 billion. And the same is true with crypto exchanges. So I think there's an entrepreneurial battle to see who's going to win the digital money race. And then there's digital yield. And in the digital yield, if the cost of capital is 400 basis points, then why wouldn't you just borrow at 400 basis points and lend at 1,150 basis points and loop it 3 times or 4 times or 5 times? And you're going to see a lot of people in the DeFi ecosystem, and they're going to loop these 8% coins 5 times to get to a 30% yield or a 40% yield. And that'll be interesting. But you can also do it if you're any kind of hedge fund in the US. I can borrow money at SOFR plus 50 basis points. So that's 425 basis points right now. So I think there's a lot of carry trade that will be coming. This entire exercise is going to be about a question of, do you create a private fund? You know, a private fund that's like illiquid or 1 month or 3 months of liquidity and go for yield? Do you create a public fund and take it public? Do you take it public in Europe or do you take it public in the US? Do you create a crypto account? Do you create a bank account? Or do you create a token? And if so, in what regime? And then there'll be a bit of battle about, are you going to do this on Ethereum or Solana? Are you going to do it on a CeFi exchange or on Base? And then how many different DeFi protocols will you link it to? So, and I haven't even mentioned the last thing, which is you can also just take STRC and do a currency transform, and you can generate 8% yields in Swiss francs or Japanese yen. So what happens if you decide to start generating 8% or 6% yields in yen, francs, euros, pounds? And those are all interesting opportunities. And all of this is an exercise in, one part is financial engineering, like how do you construct the volatility reserves and how do you manage the operation. One part is design. Are you going to offer daily liquidity, daily dividends, 0 vol? Are you going to offer monthly liquidity, 5 vol? You know, there are senior and junior tranches. So part of it is that. Part of it is distribution. Can you get distribution from the Commonwealth Bank of Australia? Can you get distribution from Deutsche Bank? Can you get distribution from Binance? So part of it's that. And then part of it's regulatory approval. Is the container a bank account, an ETF, an ETP, a crypto token, et cetera? And that's a lot of work. And I don't even know the right answer, except I rather think we're shipping kerosene or gasoline, and we think there's a world of motor vehicles and service stations and trains and planes and automobiles and things to be built. And we kind of need all of the digital yield, digital money partners to build all of those things, because probably you know, if you're a conservative investor in Switzerland, you don't want the same product as a Japanese retiree or as a, you know, a hedge fund in London. So I think there'll be different products for different investors, but the addressable market is, you know, if it's 10% of the credit market, it's $30 trillion.
But the lion's share of the innovation is happening here in the U.S. with U.S. regulators and U.S. banks at the moment. You touched upon regulatory. There are a ton of foreign issuers here, foreign corporates that would like to experiment with this. But there is a big regulatory differential, huge, right? Jurisdiction by jurisdiction. What's your experience in traveling the world and talking to these regulators in terms of their willingness to be thoughtful and innovate against this by major jurisdictions?
I think the race for leadership is between the USA and the UAE. And those are the two most progressive jurisdictions. And everywhere else is a different story. And there are some things that are easier to do in certain places. But this is a global phenomenon. And the money is in Japan, or in Brazil, or in Switzerland, or in Germany, or in the UAE, or the Kingdom of Saudi Arabia, or the US, or Canada. There are going to be products in every one of those places, I think, that are going to be built on digital credit and ultimately on digital capital. And I think that the entire industry is going to accelerate starting now. I think there's going to be a Cambrian explosion. Just the past 12 weeks, I've seen more innovation in this space than in the previous 5 years.
Yeah, and to talk about kerosene and gas, I mean, the next upcycle is only going to accelerate, having seen the resilience of Bitcoin through this part of the cycle and the advancements we've been able to make. Just curious in terms of what your thoughts are, what's next, what should we be excited about closing out this year of 2026?
Well, I think Bitcoin's going to rally. I think there's a lot of capital flowing into Bitcoin right now, and at the rate that digital credit is forming, and at the rate, you saw our buy this morning, we bought the entire supply last week, then Strive announced a massive buy, then there's a massive bank credit coming online, all the big banks, JP Morgan, Citi, Schwab, Morgan Stanley, Barclays, they're all coming online. So I think the formation of, you're talking about between 20 and 100 billion dollars worth of credit formation in the next 12 months, and there's only $10 billion of Bitcoin naturally available for sale. So I think that we're setting up a massive supply shock. There ought to be a rally in BTC. I think that'll catalyze a rally in all the Bitcoin treasury companies. I think it will cause a rally in demand for digital credit. I think there'll be a rally in bank credit. I think the Clarity Act will go through, and there'll be a lot of very constructive guidance from the CFTC, Treasury, and the SEC. I think that will accelerate digital assets innovation. And I actually think that there's going to be a coming together of the altcoin or stablecoin industry and the crypto industry and the Bitcoin community. Because I think what's going to happen is that digital credit is going to power all of the stable coins. And what's going to happen is that $350 trillion stablecoin industry is going to gradually begin to adopt digital credit, and they're going to realize that a much better idea is a Bitcoin-backed stablecoin that pays 8%. And so the Bitcoin community hasn't had a lot in common with the crypto community for the past few years, but now the interests are crossing, and tokenizing stable coins and staking them to generate yield using digital credit that drives demand for Bitcoin means that the Solana ecosystem, the Ethereum ecosystem, the DeFi ecosystem, every protocol, every digital token idea, every perpetual source of leverage, all of the DeFi exchanges, all of them are going to be engines driving demand for Bitcoin, which we haven't really had. It used to be they were competing for capital with Bitcoin, And now they're going to align and they're going to drive capital into Bitcoin, which will drive growth into their ecosystems. I think we're entering into a virtuous cycle. It's going to be good for everybody in the digital assets industry.
Well, let's end on that note. Thank you. And I just want to thank Michael for your vision and your unwavering leadership.
Yeah, thank you. Thanks, all of you.